Welcome to Grade 12 Accounting. Chapter 15, Corporations, Dividends, Retained Earnings, and Income Reporting.
A dividend is a distribution of a portion of a corporation's earnings to its shareholders. There are two types of dividends: cash dividends and stock dividends.
For a corporation to pay a cash dividend, it must have all of the following: sufficient retained earnings, adequate cash, and a declaration of dividends.
There are three important dates for dividends. The declaration date is the date the Board of Directors formally authorizes and announces the cash dividends. The record date is the date when ownership of the outstanding shares is determined for dividend purposes. The payment date is the date the dividend checks are mailed to the shareholders and the payment of the dividend is recorded. A stock dividend results in a decrease in retained earnings and an increase in share capital. Stock dividends also result in the book value per share decreasing and the number of shares issued increasing.
Stock splits involve the issue of shares according to the percentage of ownership. A stock split causes a reduction in the legal capital per share. It is not necessary to journalize a stock split since it does not affect the balances in any shareholders' equity accounts. Retained earnings are cumulative net earnings less losses that is retained in the business. This is the equation to find the ending balance of retained earnings.
There are three retained earnings restrictions. Contractual restrictions may occur due to long-term debt contracts that may impose a restriction on retained earnings as a condition for a loan. Voluntary restrictions occur when the Board of Directors restrict retained earnings for a specific purpose. Legal restrictions are imposed by the government.
This is a statement of retained earnings. On the first line, you write the balance of January 1st as previously reported. This is the second line where you add or subtract a correction for understatement of net income due to unrecorded sales in the prior period, or the cumulative effect of a change in accounting principles. After making corrections, you write the January 1st adjusted balance. On the fourth line, you add net income. On the fifth line, you subtract cash and stock dividends paid out to shareholders. On the last line is the balance of retained earnings at the end of the period.
Income statements for corporations are the same as the statements for proprietorships or partnerships, except for the income tax expense section. A corporation is considered a separate legal entity for income tax purposes. Income tax is calculated annually on the income of the corporation, but must be estimated to be remitted monthly. The journal entry for this is debiting income tax expense and crediting income tax payable. Inter-period tax allocation is allocation of income taxes between two or more periods.
Intra-period tax allocation is association of income taxes in a specified period with related items of income. Thanks for listening. Hope this helped.